Good evening and welcome to the FiTT Show. Financial information for today and tomorrow. I'm Bobby P. Kinzer.
And I'm Thomas Doty.
And we are the FiTT Show, and we're back at you, helping our folks get their finances in shape. It is so good to see you, Dote. You're looking like $1 million with all that gold around your neck.
Hi.
So
How you
look,
doing,
thank
man?
you all. We've been away. It's summertime. We have little vacation spurts here and there, so we take that little break. So thank you for bearing with us. But we're back here again, and we'll be back with you for a few more weeks. We might have one more hiatus before the fall starts, but we're here well, hopefully every Thursday at God, at 8 p.m. Eastern Daylight Time, as we go right now, on Facebook and on YouTube. And please make sure you share on Facebook and subscribe on YouTube. We really appreciate it. And the more comments you put in the box, the better it is for us, because that's how you get traction to the people. And we just have to give a disclaimer. We're not qualified financial advisors. We're not licensed. We are financial educators. So keep that in mind, ladies and gentlemen. And also, we'd like for you to place as many comments. Or first of all, you need to click on the like button and the heart button, because that's also another way that we use the algorithms and Facebook to reach more people. Then, after you do that, we'd like for you, if you have comments on anything we're saying, questions about anything we talked about, or a topic that you'd like for us to cover in another session, please put it in the comment box, because the comment box is even greater, because for some reason it reaches way more people when you put comments in the comment box, even if you just said hi. So we appreciate if you do that. Thank you. We got the administrative stuff out the way. Thomas Doty, has been a week that we've been off, and where did you go this time?
West Palm Beach, Florida.
Okay.
Just kinda
Oh man,
with my grandkids.
how was the temperature down? The
It
temperature
was
down.
nice. It wasn't too hot, and it's kind of nice because all their kids are back in school. So this is the
Right,
time
right.
to go. The beaches are empty, and the
It's that
restaurants
time of
aren't
the year.
crowded. So
It's that
it's
time of the year, people. His kids are back in school. Good gracious.
yeah.
Yo, we get ready to be in September, man. Good time is moving. This is our 248th show, though. We rolling there, boss. And we have not duplicated a subject yet. Let me make sure I put on Do Not Disturb so that we do not jump into our show. So, as we always do, we start off with um, an update in the stock market, and man, dope. Tell us what's going on, man.
Just pure craziness. That's what we're going to talk about on the show. But
That's about the best way to explain it, isn't it?
yeah, it's been really choppy, very very choppy, and that's one of the reasons why you diversify. And if anybody who follows the stocks that I own, notice it's always up and down. Okay, so for the 2 week period ending August 27th or today, Nasdaq is down 1%, and the S&P is actually down about 1%. But the stocks I own have done pretty well. Microsoft's up, Apple's up, Nvidia is up, and Nvidia had taken a big hit. It went up about 18 points today, and so it ended up for the 2 week period being up a little bit. Now Google's down, and this is another one. I may actually buy some more because Google was up around 400 in May, and the investment community has been just shocked by the amount of capital spending that they're putting out to in this AI race, and they got a lot of people they're fighting with, and everybody's not going to win, and so there's been some profit taking, and the stock has actually come down. Like I said, it was up around 395 in May, so it's down about 15% from that high. But their earnings were still excellent. Their growth is still very good. And fundamentally, it's still a great company. And that's why I may consider buying some more and just look at this as a little setback. But the worry is that the amount of money they're spending on AI can't be recouped in earnings. That's the worry. But like I said, the earning growth has continued to do very, very well. So that's what I'm keeping an eye on. Pfizer's up a buck, and my Boston Scientific is down. It had gotten on a little run, but had a little bit of bad luck recently. It had a cyber attack that hit their systems. And so there's concern that that may end up affecting their Q3 earnings. And also the Watchman, the tool I told you about that controls that atrial fibrillation, the sales have not been as strong as they had hoped. So this is one I may decide to cut loose in the next couple of days, but we're going to see how things shake out, because I may end up buying some more of this too. So I'm not really sure at this point. But all in all, the market continues to be volatile between the war, the AI race, political environment. It's been a crazy ride, and we'll explain why, if you're in, you ought to stay in. And that's what we're going to talk about tonight.
Yeah, I just, like I always share, you buy a couple of stocks. Well, I got quite a few, but my NXP, which is sort of like a competitor to NVIDIA, they out of Holland. I've had it some time. They're over 200. They're at $225 a share. I got in, I think, though, at $106 a share back in 2017. And they're doing well. Gold, no, another stock, General Electric, though. I told you before, I think that war is having something to do with that particular stock, because it's now over $300 a share. It's $343 a share. I had a reverse stock split. I had over 200 shares and a reverse stock split down to I ended up with just 70 shares, and it was at $70. No, not 70 shares. Yeah, 70 shares. Reverse stock split from 200 shares. Stock split usually go the other way, but it went down. But it came back. It got as low as $50 a share though, and that was about just before the pandemic. And now it's over $300 a share. So that's doing pretty well. And though, is this all your stocks that you're showing?
No, I got one other, Costco.
Just one other one though, right?
Yeah, just Costco. Yeah.
Right. Yeah. Yeah. Okay. And I have a couple of other ones too, but I was wondering, was this it? So you showing your whole portfolio? That's pretty good, because people always usually tell you the good ones, right? Don't tell you the ones that lose.
But and Costco, and I don't know why. I'll probably show Costco instead of if I sell Boston Scientific. Costco's one I bought it like $250, and it's up to $900.
What? How long you had?
Good on that one too.
How long did you have?
Oh, it's been a while. I've always been a big Costco fan, and that's one of the things I've learned to do. If I find something that I like a lot and think it makes sense and has a good business backing or a good business background, I'll buy stock in it. And that's why I bought Apple a long time ago. And Costco's the same way. They have a business model where they just try to make 8% on what they sell. They try to have good quality products and sell it at 8%. And that's what I found. I bought so many things in my life at Costco that I ended up buying stock.
Well, that's one of the strategies that I always give to people, because a lot of people, a lot of stock purchasing and research is based on fundamental analysis and technical analysis. But I used to tell people, one of the layman's way of doing it, if it's a product that you buy and use every day, like say Colgate or Bounty or toilet paper, right? Why not invest in it? You're using it. And if it's doing well too, other than that, and you use it, why not own a part of it? So, like you said, Costco, you use it a lot, and this paid off for you. And yeah, I just have a couple of other stocks too, though. And just one, it's just been dragging. It's this Tilray, which is a cannabis stock, right, out of Canada. And I thought since under Biden, he was going to pass the law where you were able to, because right now, under the Bank Secrecy Act, you cannot, um, companies that sell marijuana cannot put money in federally insured banks by the FDIC. And Biden was getting ready to lift that um, regulation, but he did not. But I think Trump is going to eventually do it. Gold is up. No, excuse me. Gold is down by $10, but it's up from several weeks ago. It's up to $4,650 an ounce, and silver is down just 13 cents, but it is up to $70 an ounce. And remember what I told you? Keep an eye on silver because all these data centers are going up. They all have about 80% use of silver that runs these semiconductors. So keep an eye on silver, though. Now, though, let's talk about cryptocurrency. Good gracious, it's up. The market cap, which is up $459 billion, though. That's 20%. The Bitcoin is up 27%. Several weeks ago, it was a week ago, excuse me, it was $63,414. It is now $80,330, up $16,916. That's a hell of a jump, though. That's why we say, God, I mean, it's so amazing about crypto, and that's why we tell you it is so volatile. You can't really peg it and know what makes it go up and down. But that's one of those investment that works like that. Ethereum is up 33%, though, up $630 to $2,500.
I don't have any Ethereum. I'm rolling with Bitcoin, but I don't have any Ethereum.
I got Bitcoin and I got Shiba Inu. Shiba Inu has not been doing too good. Shiba Inu is what they call a meme coin. You know, a meme coin is like they use like a card or a face or an emblem is a meme coin. And it was doing real well several years ago, but it's dragged. But it's, believe it or not, it was up. It's up by a couple of dollars today though. But that one has been a stinker. But I got Bitcoin also though, and Ripple. Binance is in the 4th position, and Ripple was in the 6th position, and it moved up to the 5th position. And the Tether coin USDC dropped down, even though it's up 1 cent. It dropped down because look at that, Ripple is up 45% though, even though it's just 45 cents. But that movement can be a lot in cryptocurrency. So just want to give y'all an update on that. Oh, I got to tell you, because I keep track of mutual funds, especially Fidelity Growth Fund, and it is up $6 net asset value, up to $312 a share. And
now, when did you get in there, Bob?
I got in there 4 years ago, and I got in with 48,000 4 years ago, and now
that would have been 2022.
Yes, right after the pandemic, and today it's up to 82,000.
So I'm looking at the S&P in that same time period.
Yeah.
This is August 27th. So it's 3924. That's what the S&P was. And what's the S&P now? 7730.
77, yeah.
7730 minus 3924. 3924 equals, wait a minute, I didn't do that right. What did I say? 7731, 7731 minus 3924. So it's up 3807. So it's up like 100%. And what? So
yes, yeah.
This is double. Yours should be. Is it double?
Yes, yes.
Yeah, that's what. So yeah,
Yes.
a growth fund should pretty much track the S&P.
Right. although Fidelity is an actively managed fund, meaning it charges a little bit more in the expense ratio for the managed fund, and the index fund, S&P index fund, is passively managed, so it doesn't have the same. It just tracks what the index is, but it's running about the same though, right? Now, what you said though?
Yeah, it should be. Yeah, it's up about 100% in the last 4 years.
Wow. Okay. So, and I got. Matter of fact, I got
Was that 100%?
yeah, I got EFT to ETF exchange traded fund too.
It's
And that's,
doubled.
yeah. So yeah, so it's doing pretty good, like we say, yo. And you know that's so interesting because that brings us to our topic today. Now, a week ago it was 2 weeks ago was beat inflation and build wealth. But today we're going to talk about should I sell? Should I sell? There's a lot loaded in that question, though. So let's get into today's show.
Yeah, and the thing that makes this relevant today is all the volatility we're having.
Right.
And this is something that you wrestle with when you own stocks of when do you get out. And so the last 3 months, it has some of the highest volatility since like the 1940s. And, between the Iran conflict and that's really keeping the market shaky. And then the AI stocks and all the capital spending they're doing. And they've been on a crazy roller coaster ride. And the big Magnificent Seven have been spending money like crazy. And so that's created a situation where the stocks are going like crazy. And so as a personal investor, you can get uncomfortable with turbulence and the volatility, but what you have to do is look at history. And that's really been kind of the foundation of healthy bull markets. And so rather a signaling that they're about to go under, the volatility pretty much tells you that the period right after that is going to usually be pretty good. And so periods of crazy volatility have been followed by market gains 96% of the time. So that's a pretty good average to want to lay some money on. And the returns have averaged about 20% over the following 2 years after a lot of volatility. So that says history has told us that higher returns often require a bumpier ride. And so it kind of leads you to believe that's why you should stay invested for the long term. Don't try to react to this crazy market volatility and just continue to invest, be invested, and invest for the long haul.
Yeah, now deciding on a single stock or fund or even a portfolio of stocks can be one of the biggest decisions that you ever, really face, especially during these crazy turbulent times. And even when, the shares start to soar, in value. Ooh, you say that 5 times real fast. Even when the shares soar in value, it can make you get antsy of what to do, but really, it's selling. It takes a skill, it takes some research, but it's the final step in a complete process, right? And the process usually go like this: you find it, you evaluate it, you value it, you buy it, you manage it, and you sell it. Now every stock connects, to the next. Every step, connects to the next step. Whether you sell stocks or wait, it depends on your personal financial goals, your cash needs, and why you bought the stock. Rather than trying to time the market like we always talk about, especially timing it in the short term, with the movements in a short term period of time. Now, avoid panic selling, doing when the stock goes down, because that's when everybody wanted to get out, which is the reverse psychology. Instead, sell if your financial goals change. If you need the money or if a company's fundamental business strength breaks down. So, to sell too early, you could potentially miss out on a lot of growth in your stocks or in your funds. You might also worry that if you hold it too long, you risk, missing, you miss the paper gains, and they may go away. So today we're going to talk a little bit about the psychology behind, well, not just the psychology, but the strategy behind selling. Should you sell stocks?
Yeah, and the key here is we're not saying you buy stock and you put your head in the sand and never sell. Okay. We talk about staying invested for the long haul and how that's delivered pretty good returns. But there are times when selling a stock can make sense and you need to think through it. And the key thing is to separate emotional reactions from informed decisions. If the decisions is if you make an informed decision that's aligned with your financial plan, that means that your goals are still in reach, that you're on track for reaching your goals. So the market environment can change, fundamental of your investments can change. And those are the things you look at, not whether or not it took a drop and you think it's going under. So it should be based on research, not by emotion. That's what you have to look at. You have to look at what the stock is doing, why it's going down, and make sure you're thinking it through before you decide to just rush out and sell.
You might ask yourself, should I sell my stocks now? And yourself might say, should I sell myself now? These are questions, right? Another question, have your investment goals or time horizon changed? Me and Dote always talk about that. Your goals, your risk tolerance, and your time horizon. Now, stocks once, made sense in your portfolio may no longer fit, in your timeline if your financial goals have shifted, right? For example, you may be approaching retirement and may want to reduce the exposure of the market volatility. You might want to preserve more your savings, and you want to generate income to fund the next stage in your life, like trips that you might be wanting to go on, or that that one car you wanted to buy one more time or so. Others may find that your priorities may change, such as needing cash for a major purchase or an unexpected event, because we know those things do happen. And when it comes down to long-term investing, having a strategy in place is essential, right? We talk about that all the time. And one consideration for selling is whether your life plans have changed.
And the other thing you got to look at, if your reasons for buying the stock can change. You can say it change your reason for owning it no longer holds. You might have bought a stock because you believed in the company's long-term prospects. You thought it might have a competitive advantage relative to its other players, or you expected the earnings to grow at a rate faster than its competitors. And so it could make sense to sell it if that environment is changes and you've reassessed. And that's kind of what I'm going through with Boston Scientific. They're still a good company, but the reaction is not growing as fast as it was. And so its stock price is taking a hit because it's not growing as fast. So it's not a true growth stock anymore. It's more of a mid growth, and it probably will still do good over time, but it won't reach the goals that I have for it. So that's why I'm considering selling. And so your reasons could change since you first added. You could do some research now, and you might look at it and say, it's just not going to do as well as I thought it was going to do. And so you got to look at the company's performance, look at its valuation, industry dynamics, and all those things to help you decide if you should keep this stock. And you got to do the homework. And if you're not doing the homework, then you're pretty much doing knee-jerk reactions, and that's not going to get it done. Those emotional reactions is never the way to buy and sell stocks. And so sometimes a stock or a whole industry could go through a temporary soft patch, and that's okay to hang through something like that. But if new information changes your long-term outlook, then selling may be the thing to do.
And don't forget, your friends or family member might have the same stock, and their reasons could be different for why it's selling. So it's important that you hone in on that. Is one stock or position taking up too much of your portfolio? Well, what I mean by that? Now, over time, and this has happened to me, a strong performer might potentially grow into a to outsized position in portfolio, which can increase the risk. For instance, if you had it, balanced with, say 60%, stocks and 40% bonds and maybe 20% bonds and 20% cash, and maybe the bonds grew faster, and it changed the whole composition of your portfolio. I want to look at that and make sure you want to stay in that position, especially if, in my instance, I was trying to stay conservative because I retired, and but my equity, my stock grew way bigger, and it also took the whole, it was making up the most of my portfolio. And once again, that's all paper. That can change at any time. So you might want to, if you have a single stock or investment comes too large, a decline in that holding could have a negative impact on your overall portfolio. You just need to look at that and think about if you want to rebalance, right? Now, Fidelity Pros, which me and Doe look both like Fidelity and we like Vanguard. They caution investors that having 5% or more, just the benchmark, not saying this is the law, or more in their portfolio in a single stock can increase your risk. Keeping positions within a target range can help maintain diversification and reduce your exposure to the fortunes of one company. In case one company goes bad or rogue or just ends up bad management. Now, if you have concentrated yourself too heavily into one company, it can be detrimental to the overall financial plan if conditions change for that specific company, even if the overall market is doing well. So portfolio drift is what they call it. It's another common reason to consider selling. If stocks have grown to represent a much larger part of your portfolio, that's what I'm trying to explain, than you intended, selling some shares to rebalance your holdings may help reset and set your risk levels at the level that you might, want to stay at.
Yeah, but let me do a little sidebar here, and not we're not going to talk about the tax implications of selling, but that's obviously something that needs to be taken into account, especially in the situation that you just talked about with a large gain.
Correct.
You have to look at the tax situation and make sure that that's not going to put you in a bad position tax wise. And that's when you might want to look at, do you have any losers to offset, that big gain you may have. So if that's the case and you do have a big gain, make sure you think through the tax consequences or talk to a tax advisor to make sure you understand your situation there.
Good point, though. Very good point.
Another reason to sell is that you may find that you got a better opportunity for your money, that another segment or market is doing better. And so if you think you can do better, invest someplace else, then obviously it makes sense to reallocate. Kind of same situation as if that stock fund becomes too big a part of your portfolio. You may decide that, hey, there's another opportunity over here that I can do in that I might do a little better than where I have my money now. And so it's trying to find the best spot for your money is something that you're going to do constantly too. That you also are going to do constantly to make sure that you are optimizing your returns. And then you get in other situations where you have to sell because something in your life changes, or you need to buy a house, or your kid decides to go to college, or gets the age of college, I take money out for there. And so that's why in some cases, you might want to avoid having too much money in stock if you know you're going to use that money for something else. So that's something else you have to take into account. If you don't want to be in a situation where you're heavily invested in stock with money that you're going to need to do something with, because you don't know where the market's going to be when it's time to use that money. So if it's money that you're going to need in the short term, you might not want to have it in the stock market, or you might want to have it in something a little more generic, like a money market fund or an ETF that is not tracking stocks. Maybe you put it in bonds or something like that. And so sometimes you have to sell because you got another use for the money, and that can be good or it could be bad depending on the situation.
Yeah, that's true talk, though. Next, does the investment still play the same role in your portfolio? Now, even if a company's outlook hasn't changed, it may still be worth reviewing whether it has the same impact on your portfolio. For example, a fund or stock, you choose for a specific purpose, especially like, say, for diversification, or you want to generate some income, or you want to have some stability. You don't want, it being going up and down all the time, or you have exposure in a certain market, may no longer serve your purpose. So portfolio managers shift strategies, changes, or the market dynamics can alter how investments behave over time. Now you might want to ask whether a fund or investment is sticking to its mission, because a lot of companies actually change up their missions. I've seen Nike do that before, and you may not agree with that. You might want to consider, moving into something else that really aligns with the mission that you would like to be with. Because a lot of people I know deal with those funds that what they call those. The government, that are environmentally conscious.
Oh yeah, there's an acronym for it.
Yeah, I'm trying to think of the acronym. That's what I was trying to think of the.
It ain't ET. It's like ESP or.
Yeah, you said yes. It's not ESP.
It's something like that. Environmental, social,
and government. ESG, I think it is.
ESG. That's what it is. I think that is.
And if it gets out, and if you're one of those people that want to be socially conscious, want the company to be, like that, you might want to, and they change out of that. That's the reason why you might want to change. Now, if holding is no longer aligned with your original purpose, selling may help bring your portfolio back in line with your strategy.
Yes, environmental, social, and governance. That's
it. Thank you. Yes. Good.
And so when it might not make sense to sell stocks, I mean, we've told you this over and over, and we hope you believe in this fully, that timing the market, it's not, you're not going to be successful at it. A lot of people think, I'm going to buy when it's high and sell when it's low. It's so difficult to execute, and in some cases it can even be counterproductive. So even if you're able to call a market top accurately, it's challenging to know when to get back in. Now, okay, you can figure out when to get out, but when do you get back in? And the result is that you can miss out on substantial gains. You're in the sidelines when the market is making its big move. So a lot of investors who trade more often, they have trouble doing this, and they get in and get out, and they can say it's the right time, but it's because they're constantly get in and get out. And why don't you pop that chart up, Bob?
Yes, we'll do that. This is a good chart, though, for what you're talking about.
Yeah, I think we've showed this before. And what it's really telling you is that if you miss, it shows the return, $10,000 invested in the S&P index. And this is from 1987 through 2025. And it shows what that 10,000 would grow to. So if you left it in and you invested all the days, you never took it out, you'd have like $616,000, which is a heck of a lot of money. By the same token, if you miss the best days, this is just 5 of the best days. So you decided to get back in and you missed just 5 of the best days. That drops your earnings tremendously down to $380,000. If you miss the best 10 days, it drops it even more to $274,000. And you can see if you miss 30 days or if you miss 80 days, which if you're figuring out when to get back in, this is when you really can get hurt, because if you miss just a few days, it can really affect your earnings to a great extent. And so if your portfolio is appropriately diversified and its risk tolerance meets where you need to be, your time frame is set to your own horizon and your own financial situation, staying invested is usually going to give you the best returns. Okay. And we have history. We have noted history that says there have been 11 U.S. recessions since 1950, about one every 7 years.
Wow.
And they average about a little less than a year. And so stock prices have often begun recovering months before the data actually shows sign of improvement. That means investors who headed for the sidelines could have missed out on those early gains. You don't want to do that. You don't want to try to time the market.
Yeah, and just want to give a definition of a bull market and bear market. A bull market is usually, I think, is 2 to 3 consecutive quarters of the market going up. That's a bull market. And the opposite is a bear market is 2 to 3 quarters, consecutive quarters is considered a bear market. And dope, based on what you said, that's amazing that, would you say it's been 11?
11 recessions.
And you said, and they last less than a year?
Less than a year.
Wow.
On average.
Wow. On that, right. Yeah, those averages. If that don't tell you a little bit about the market, though, good gracious,
it's going to be rocky times. It's going to be rocky times, but you got to grit your teeth and just bear through it, knowing history has always said better days are ahead.
Yeah. But the bottom line, though, on when to sell stocks, it comes down to choosing when to sell a stock. It's a tough decision, like I said, one that should be well grounded in research and insight. Still, there are times when it makes sense to reduce or exit a position, including when your financial plan changes, your portfolio drifts off course, or new information about investment emerges. That's why you need to keep up on, the stocks you have. You check on them, and we talk about this all the time. Instead of reacting to fear in the market or exuberance, because all stocks are soaring and going up and just increasing in gain and value. What can help you cause and maintain a disciplined approach is being patient. That's one of the biggest things they say in investing that people really have problems with actually building wealth in general is being patient. Reviewing portfolios periodically, you have to do that. It's on you how periodic you need to do it. But the more you do it, I think the better you are. And, the more it gives you confidence because you know it's going, whether it's good or bad. Because what's the saying, though? Alex Baldwin said, not everything we face we can change, but you can't change nothing unless you face it. And it's so important, so staying diversified and or adjusting over time is very important, and making sure that your investments are aligned with your financial goals. Me and Dope cannot repeat that enough. Financial goals, risk tolerance, and time horizon. Ultimately, you should ask yourself, should I sell stocks now? Then you need to be confident that making that sell, it helps you to keep on track.
And if you don't want to take on the rigor of doing research and deciding when to sell and rebalancing, then go get an S&P index fund. And it's kind of like that old Ron Pompeo used to say, set it and forget it.
Right.
Just buy S&P index fund. You don't have to worry about buying and selling. You don't have to worry about rebalancing. You don't have to worry about when to get out, when to get in. You just buy an S&P fund, continually invest in it, And we showed what what a $10,000 investment, just a $10,000 investment, did over that. Was that about 40-year time frame, 87 to 25,
25, yeah.
38 years. That $10,000 grew to almost $700,000. What about? And so
Yep.
that's just hopping in the S&P and leaving it, and that's not even including any additional investments. That's just that $10,000. So if you want to be an investor, then you have to do the work. You have to think it through. You have to keep emotions out of your decisions, and you have to be willing to adjust when necessary.
Yeah, so true, Doug. So that brings us to you all. Once again, that's a lot of information in a 10-pound bag, about 20 pounds of information. But we hope you, if it's something that you want to revisit, remember you can always go back out. It stays out on Facebook for 30 days, you all. It stays it stays out there permanently on YouTube, I believe. So if it's something you want to go back on, because a lot of people always are asking me though, when should I buy? When should I sell? And we hope this will help you. But
And that's the thing. That's the thing. But people think it's easy, and it's not easy. It's not easy to make money, and well, it's kind of easy, but it's easy once you get started. Okay,
Right.
Once you start saving, once you get consistent, putting money away, once you hit your first milestone, whether it's your first 10,000 or your first 50,000 or your first 100,000 or your first million, once you hit those, once you hit those standards, it kind of encourages you to continue to do that, and it does become easy once you start making money without doing anything. I mean, you look at it. If you got $100,000, even if you put it in a 4% money market fund, you're gonna make $4,000. That's over $300 a month you make for doing absolutely nothing. Okay, and you go to S&P where you're averaging 10% on average. Now you're talking about making $100,000. That's not including dividends or things of that sort. So it's hard to get started. It's hard to have the discipline to put all your extra money away, and that's the thing I recommend for young people is to start valuing the growth in your bank account versus these marketing things that get your attention, like tennis shoes and cars and the latest fashion and coffee and alcohol and things of that sort that in 5 years will not mean anything to you versus investments,
Yeah, Doug, you take the first takeaway.
Okay, and first, don't panic. Don't just sell because you think Chicken Little tells you the world's coming to an end. Make sure you have a good reason for selling, not because of emotion or panic.
Next, invest with thought. Be intentional. Take your time and think about what it is and why you're doing what you is, because you don't ever invest in something that you don't understand. You must take time and think about your goals, your risks, your purpose. So take some time and be intentional with your thought.
You sell for the right reasons. There are good reasons to sell a stock. The company's not performing as you thought it would. There's been a fundamental change in how they do business. It becomes too big a part of your portfolio. There are good reasons to sell. So if you do sell, make sure you're selling for the right reasons.
Yeah, just don't be doing it because somebody told you. They had a knee-jerk reaction. What's that? Keeping up with the Joneses. next one, me and Dope, we ride this. I know y'all probably get tired, but it's time in the market, not timing the market. It's about being consistent. And we showed you the chart, where you showed, staying fully invested or missing 10 days or 5 days or more days, how that can affect your growth in building wealth. So remember, it's time in the market. But, there's times that you might need to come out. Like, don't say you might have to do what they call harvesting. If you just got those losses and they just didn't come back, you might want to go ahead and take advantage of those losses, which is called tax harvesting. So time in the market is so important.
Yeah, and finally, investing is a process. It's not simple. If you're going to buy individual stocks, you got to do research. You have to understand the financial background of the company. You have to understand numbers, what they mean. You have to understand the market that the company plays in. You have to know a little bit about the competitors. You have to stay up on what they're doing, what their results are, what their competitors are doing. And it's not for everybody. Everybody doesn't have the mental capability to do it. A lot of people don't have the time it takes to do it. And again, it's not for everybody, but there are alternatives. That's when we talk about an S&P index fund. The important thing is that you find what's best for you, what works for you, and what allows you to take advantage of investing. It's like I always try to remind you guys, it's like trying to play a game and you don't know the rules. Well, the rules of the United States tax code is that investors have several tax advantages that people who don't invest do not have. As simple as putting your money in a money market versus putting your money in a dividend stock. And in a dividend stock, if it's a qualified dividend, then 15% of that income is excluded from taxes. Whereas if you have your money in a checking account, a money market account, all that money is counted as if you invest and have a capital gain, then you only have to pay either 0, 15, or 20% depending on your income, versus again ordinary income being taxed to the full extent of the tax rate. So the tax code is giving you advantages, but you only get those advantages if you are investing. So it's not for everybody, but kind of it should be. That's the way the rules are written.
And most people think that wealth was built because of inheritance. No, it isn't, though. Research shows that most people's wealth has been earned through investing. And just want to remind you of the process, you all. Find, evaluate, value, buy, manage, and sell. That's one of the process. That's the end process of going into stocks, getting into the stock market, getting into bonds, getting into real estate, whatever it is. It's the same process. You just must take time to do that. Just want to give a shout out to all the folks. Garnett, thank you for being on as usual. And the original Hoya Destroyer. What's up, Michael Graham? You being consistent. Thanks for hanging in there with us. And Dope, I want to talk to you, introduce to you the greatest Toastmaster in the world, which is Kitty Cheney. Kitty Cheney said, what she said, should I sell? I hope you know now, should you or should you not? Modestine, what's happening? Modestine down there in Lexington, South Kakalaki. I wonder how close that is to Dope. How close are you to, what part of South Carolina are you in, Dope?
I'm right outside of Charlotte.
Right.
I'm right outside of Charlotte.
What's the name of that place again?
Fort Mill, South Carolina.
Fort Mill, yeah. Is that close by, Modestine? Rodney L. Madison Sr. Rodney been sending me some investments about his investments of holding mortgage notes where you become like the bank. Another alternative investment, like all investments say, risk is involved. Know what you're investing in. Go out there. It's the noteexperience.com. You can find out all all about it. Rodney Madison Sr. Now, Dodie, what's up now? How you doing, dear? Wishing you the best. Joanne Skinner, you're always a winner, but you said you're late. I saw you came in. Oh, you came in real late too, Joanne. But you're here. So we got you in the roll call. Okay.
Sound like you stretching your underarm or something, Bob.
No, it's this paper. It's this paper that I had sitting on the computer. Sorry about that. I didn't know it could pick up that good. That's a pretty good microphone. So, though it's been a while since I've gave Big Bob's quote of the week, and I hope y'all get this one because this is a very one dear to my heart, and it's very simple though. I pray you never again have to choose between being loved and being yourself.
Okay.
Does that fit your standards though?
Oh, definitely.
Keep that one. That's
Definitely.
a keep. No lie, I like that one. Too many people trying to be somebody what somebody else want them to be. Trying to be loved. You know the best way to be loved? Give love. How about that?
For sure.
Don't give me this philosophy. So look, thank you all. We'll be here next week, right? Dope. We're not going nowhere.
No, we're not.
Yes. Yep.
I'm gonna be at the U.S. Open.
Oh, you are going to be on.
I'm gonna be at the U.S. Open.
Will we be doing the show?
No, I'll be at the Open.
Oh, dope. You didn't. Oh man, I know that you told me you were going in New York. Oh, excuse me. See, ladies and gentlemen, we're being in the market due.
Hey, I have been blessed beyond my wildest dreams, but
yeah, me too, though. God bless you, man. So next week, y'all, we won't be here again, but we'll be here the week
after. We will. I'm staying put for a while.
Wait a minute, not me. I'm going to Nashville to the Dove Awards, the Gospel Awards, though, in October.
October.
Yeah, the second week in October.
Hey, but we're gonna do a show together the first week of October.
Yes. Oh, yes. Oh, because we're going up to the Nittany Lion Black.
Yeah, we're gonna do a show together.
First time. It's gonna be a first. He's gonna be in a computer right next to me. Because I ain't sitting on the same seat with you trying to look at the daggone screen. But yeah, we're going to do it in the same place. I forgot about that, though. So look, y'all, we'll be here next week, but we'll be there the week after next. So Thank you all for tuning in. And like I said, after this summer, we go straight through the fall. There's not too many times we're going to miss a show unless it's a major holiday or another major personal event. But that's how we do it. We're here mostly. This is our 248th show. So thank you all for tuning in. Make sure y'all go tell some other people. We're now past the 500 viewers mark. We're up to about 510. So we still getting new people. Oh, and by the way, ladies and gentlemen, please go out there on Libro, LIBRO.FM. My audiobook has now been released, and I actually narrated my own audiobook, though. So it's going to have a little different flavor than when you read it. When you read it yourself. And I got a couple of new gems in that. So if you go out there, check it out on Libro and on Kobo.com. And they're negotiating now with Audible.com to put on Audible and Spotify. So I'm back again, though, with a new product, and I hope you all can go out there and check it out. Life is good, though, I must admit. So we look forward to seeing y'all in 2 weeks. Have a wonderful, wonderful vacation your own self until we see y'all again. Have a good day.